Ranking the Magnificent Seven stocks from the best one to the worst one, mainly based on valuation and the risk to reward setup. I'll be going through some of recent highlights from the earnings report, some recent highlight even from the earnings calls in a lot of those companies. And I'll be posting them in this board from what I believe is the best one on a risk to reward basis all the way down to the worst one. And I'll try to keep it short, so I really hope you enjoy it as always. Now, the first one, which I believe is presenting currently the best risk to reward amongst the big seven, and it's a very, very hated stock, and this is Meta. Meta is down about 14% year to date. The company did miss on earnings, $6.18 versus $7.22 of earnings per share. It was largely due to one-time expenses. They put in $2.4 billion in charges related to legal matters and about a $1.1 billion cost whenever they were trying to, fire some employees. I believe last year they had to incur some costs in general. But I believe the earnings report was very solid. The company is growing 28% in revenue. This is massive, massive growth for Meta. Now, if you know Meta, you know the apps that they own. They own Facebook, they own Facebook Messenger, they own Instagram, they own WhatsApp, they own Threads, and they own a few more things. But the biggest one that hasn't been monetized yet is WhatsApp. And we all look at WhatsApp. It's such an amazing business. It has over 3 billion daily active users. During the World Cup, WhatsApp hit an all-time high messaging record at 30 million messages sent per second in the World Cup. 30 million messages per second. Once you own such a network, the monetization potential is absolutely massive. But Meta hasn't been monetizing WhatsApp accordingly, and this is finally about to change, but the market doesn't care about it and is sending the stock down like 10 or 11%. And the way they look at monetizing WhatsApp is through agentic experiences. So agents will be a big part of the future, in my opinion. A lot of businesses use agents, and I think all of us will have a personal agent that takes appointments for us, pays certain bills, and does certain things. And the biggest beneficiary of the agentic experience is Meta, because they own the platform. And this is what they said. They said, we made Meta business agents available globally this quarter on WhatsApp and messengers. There are already more than 1 million businesses using them to talk to their customers or to complete sales every week. Now, if you're in the United States, you don't know that as much, but most of the businesses outside the United States, you go on their website, they all have a WhatsApp button or a WhatsApp number, and you chat with them on WhatsApp. You make a reservation for a restaurant on WhatsApp. You want to rent a car or anything, you do it by messaging them on WhatsApp. Most of those things are done on WhatsApp. So those businesses, instead of having people answer all those other inquiries, they can have agents that they pay Meta for, and they create an agent for their business, and this agent will answer your questions, will book your appointments, will give you certain information, and this is how they could potentially monetize WhatsApp. And now they're rolling it also on Instagram, which could potentially be huge. They said, and soon it will go further, including suggesting ways to grow your business, giving you competitive intelligence and real-time insights into what's working and what's not. In terms of how we will monetize it, we have a mix of subscriptions, volume-based pricing, and I expect that we're going to continue to evolve more of these products to be like our ad system, where businesses only pay us when we achieve results for them. This could be a game changer, guys, how they can potentially monetize WhatsApp with agentic experiences, and they can charge subscriptions to those businesses for creating agents for them. And those businesses would save money from the people that replies. The agent would be replying. It could deliver results. And if it delivers results, then Meta could get paid some kind of a commission or some kind of a subscription for having those agents. So this is huge, guys. It could be a game changer for the company, but the market don't care and investors don't care because they can only look at the stock price. Now, if you look at the PE ratio chart, it's trading at 17 times earnings. 17 times earnings is dirt cheap for a company like Meta with such untapped potential. Like if they just launch like Apple Pay, like Meta Pay or WhatsApp Pay within WhatsApp, And people are on WhatsApp, they can send money directly on some stablecoin platform that Meta owns, and Meta get commissions to 3 billion people. That could be huge, guys. I mean, the monetization potential is huge. And I think 17 times earnings is cheap for that. Now, people believe that Meta could be flat forever because they're spending on CapEx. I don't think this is true, but let's assume that happened. If Meta keeps growing earnings per share about 15% for the next 3 years, and the stock remains flat, Meta would be trading at 11 times earnings. Do you think Meta will trade at 11 times earnings? I don't think so. So I don't think Meta will remain flat just because they're spending on CapEx. So I view this pullback as a buying opportunity on Meta, and I already have people in the comments blaming me because I did videos on Meta at 600 and it's at 550. But they also blame me on Microsoft, GFL, Amazon, all before they skyrocketed a lot. So a lot of the stocks I talk about, they go down before they go up. And to me, it's a buying opportunity. Now, the second one, which I believe is one of the best risk to reward setups in this market, I believe is NVIDIA. NVIDIA, I normally rank it at number 4 or number 5. This time I have NVIDIA at number 2 because I believe it's looking very, very attractive. Now, NVIDIA is still up about 6% on the year. The company is trading at about 20 times forward earnings. 20 times looks very cheap for NVIDIA. And a lot of people even believe that the reason why NVIDIA has been flat for over a year is because it's too big, like it's almost $5 trillion. So it's really hard to move the stock. I personally don't think this is the reason. I think there's a reason why NVIDIA's PE is trading at 20 times. And one of those reasons is the concern that CapEx could potentially be peaking in 2027 as the company's free cash flow like Amazon and Microsoft could trough in 2027, and then CapEx growth will start to decline. So after 2027, companies will be spending on CapEx, but CapEx will no longer be growing 100% year on year, could be growing 10%, 20%, 25%. And Meta said the same thing. Meta said we're front loading for 26 and 27. Other companies said the same thing. So there's worries on Meta and some kind of peak CapEx concerns, in my opinion, which are causing NVIDIA to trade at 20 times earnings. I think NVIDIA should trade at 20 times earnings. Now, I believe after 2030, 2031, so 5 years from now, the AI cycle, CapEx cycle, would have mostly played out. And after 2031, there's unlikely to be another internet cycle or another AI-like cycle. So it would be, you could say, at a mid-cycle or not, where there's nothing too exciting. Now, the last time there was nothing too exciting was between 2009 and 2018. In this period, outside a major cycle, the average PE ratio for the semiconductor ETF was 17.5. So if you believe 2031, the CapEx cycle would have played out, and you're trying to value an exit multiple, I think we should use a PE multiple where we had pretty much no major cycle, and that would be 17.5. And this is exactly what I did on NVIDIA. I put in the current guidance and estimates of 88% growth, 43%, and 24%. And I put them in this one, 88%, 43%, 24%. Then I assume 20% for the following 2 years. And this one should say 2031, but it's 5 years total. And I put in 18 times earnings. The current trailing PE is 42 times. Forward is 20. I put in 18 times, which is conservative. Now, after everything, I'm still getting about 100% on the upside, or about a 15% annual return on Meta, despite using 18 times earnings. So I think Meta over here, I should say NVIDIA, is presenting an amazing risk to reward setup, in my opinion. It's looking really, really good. And I normally ranked it 4 or 5. I'm putting it right now at number 2 because I like it very much. I think a lot of it is priced in. The P could be 20 or 25. Maybe we could have another cycle like some, data center space or whatever. And NVIDIA is friends with Elon Musk, and SpaceX is the leader, and they might use NVIDIA chips. So a lot of things could happen, and I like it. I think number 2 is good for NVIDIA, and I think the stock is undervalued. Now, the third one on this list, which I was putting number 1 the last time, was actually Microsoft. Microsoft, to me, is finally playing out the stock is up 25% on the month. And I'm seeing many people taking profits on Microsoft, saying maybe the stock is overvalued. It's up 25%, it's just overvalued. But if you look at the PE ratio, Microsoft is still trading at 23 times earnings. This is like at its 2022 bottom, it was trading at 23 times earnings. The stock used to trade as high as 35, 36 times earnings. Now it's trading at 23 times earnings, and people are telling me Microsoft's overvalued. I don't see Microsoft as being extremely overvalued. You have their cloud business, it's reaccelerating, and it's growing 43% year on year. You have other businesses like the 365 growing 14%. You have Xbox and others, they're declining 4%. But all in all, it was an amazing quarter for a company like Microsoft, and it's only trading at about 23 times earnings while growing earnings per share 22%. Expected to grow 13, 18, and 20%. I don't see 23 times earnings as extremely overvalued for Microsoft. I think it's getting closer to fair value, but I personally would not exit my entire position if I just believe that Microsoft's overvalued, because to me it's nowhere close to being overvalued at all. So I like Microsoft over here, and I put it at number 3. I still own the stock, and it's finally playing out. Now, number 4, which is actually my largest position in my portfolio, is Amazon. And Amazon is finally starting to play out as well. The stock is up almost 20% year to date. The quarter was amazing for Amazon. The core business grew 15%, physical stores 4%, third party 16%, advertising 26%, subscriptions 12%, and Amazon Web Services reaccelerated again from 28% to 36% year over year. I mean, it was an amazing quarter. And you can't look at Amazon and say something bad. I mean, I couldn't find anything bad in the quarter. It was just an amazing quarter. Now, in terms of some comments that the CEO highlighted, it's pretty much what I've been saying for over a year. And people keep telling me, oh, they're spending all this CapEx. They're going to have to spend it every year. And people don't understand the difference between maintenance CapEx and growth CapEx. And not 100% of the CapEx is not all on semiconductors and chips. A lot of it is on infrastructure that could be here for many, many years to come. They said once a data center opens with servers plugged in, we start generating significant revenue right away, then get to monetize these data centers for 30 years plus without having to spend the startup capital again. It takes as little as 3 years to break even on the event environment. The servers currently have a useful life of 5 to 6 years. So a portion of the CapEx is on semiconductors, which they have to buy every 5 or 6 years when they depreciate them. But in terms of the core assets, the infrastructures, the data centers, they can keep using them for 30 years, which means the CapEx over time will naturally come down, even if they have to spend more on semiconductors. So this is the whole thing that people are not understanding, is they're selling the big 7 because of CapEx, but a lot of this CapEx is gross CapEx, not maintenance CapEx, and a lot of it is to build those assets that they don't have to rebuild for the next 20, 30 years, and they only have to buy the semiconductors, which will ultimately get cheaper over time as a lot of companies expand into creating their own chips. So this is the part that a lot of people don't understand. Now, if you look at Amazon, it's still trading at 15 times operating cash flow. Even after this rally, it's not back to its average. 15 times operating cash flow is cheap, and it's growing operating cash flow 35%, expected to grow 26% and 31%. Amazon is very, very cheap over here. For me personally, I'm looking to buy more of Amazon under $230. Any dip under $230, I'll personally be buying the stock. It's my largest position by far, and I think the company is only getting started, especially in robotics and so many other, in Amazon Leo and space and so many things, all within one company. So I like Amazon very much. And by the way, I'm using Fiscal.ai to come up with all those charts. If you want to try it out, they give you 15% off if you use my link in the description. But Amazon, of course, deserves a 4 here, 100%. Now, the one after Amazon, I would personally put Google as number 5. Google has also been recovering. it's up 13% year on year. I don't really have much to say on Google because I did a video on it recently, but it's again now trading at 27 times earnings. 27 times for me is a little bit expensive for a company like Google. So from here personally, I would not see a multiple expansion on Google. I would mainly bet on earnings per share growth. So if they grow 15, 18, 20%, then, it could return 15, 18, or 20%. But with other companies like Microsoft, for example, and Meta, like Meta, you're buying it for like 17 times. You're not only getting a potential earnings per share growth, but you're also getting a potential multiple reversion back to 22 times, 25 times. So you have some runways on the multiple. Same thing with Microsoft or Nvidia. With Nvidia, you have runways on the multiple. With Google, I don't believe you have a lot of runways on the multiple unless you want to bet that it goes to 35 times earnings, which anything is possible in the market. But this is not a bet that I'm willing to make on Google. But Google has been doing well. Google Cloud is growing and everything's been getting better. But I think the stock is fully priced, to be honest. Like if it gets to 250, 270, then it starts to get really interesting. But other than that, to me, Google is kind of fully priced in general. So this is why I put it number 5. Number 6 is Apple. Apple, I also don't have much to say on Apple, but to me, it's really funny how the market was rewarding Apple and it's still rewarding Apple for not spending on CapEx. So Apple is not actually innovating. They're not spending to grow the business. They're still growing mid-single digits, and they're inflating earnings per share growth by spending more than 100% of free cash flow on buybacks. This is good for short-term investors on Wall Street. But once you have companies like Amazon, they are investing for the long term to grow the business, to widen the moat. For Wall Street, this is bad because they're not giving it back to us right now. To me, this is crazy how the market thinks and how Wall Street thinks in general. And I don't know what to tell you guys. Like, if you want to buy Apple at 34 times earnings, go ahead. I'll buy a Google over Apple any day. I would buy Microsoft or Meta or Amazon or any of those stocks over Apple any day. I think Apple is still expensive, and I like companies that reinvest in themselves instead of giving it to me back as a shareholder in terms of buybacks and dividends. The last one is Tesla. I don't have much to say on Tesla. I really don't understand the business well, to be honest. I don't understand their robotics exposure. I don't understand their, robo-taxis or whatever it is, competing with Waymo. But I think most of you guys know that the stock is mostly a story stock. So it's a lot about Elon Musk and, things that could happen with Elon Musk and innovations. And it will pretty much never trade at fair value. Like, it will always have the Elon Musk premium. And to me, I don't like to get involved with those names. But this is my ranking on all those stocks, and I tried to keep it short. So I hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.